Economic growth in the U.S. quickened, but then concerns about slowing growth rattled markets. Pre-election uncertainty starting to make people wonder about what will happen in the next year. The Federal Reserve cut rates by 0.5% as lower inflationary pressure gave the Fed more confidence. How to be smart with cash, that and more, plus general key retirement planning review items and other information in this quarterly context webinar for WealthStep. Watch to stay informed and stay relaxed by being up to date with the things that matter the most regarding your long-term goals and strategy for your retirement readiness. Welcome to WealthStep's quarterly context webinar for the third quarter of 2024. WealthStep is an online financial guide to help people in 401k plans and other individuals make smart decisions about how much money they need to retire and how much to save and how to invest now to get there. These webinars are designed to make economic and other information approachable, high-level perspective regarding the economy, markets, and investor behavior patterns to help you stay more relaxed by staying informed. We try to keep this to about 15 or 20 minutes, and recordings will be put on the blog at wealthstep.com. Pass it on to people to help them achieve retirement readiness too. As always, the context within which we are conducting these presentations is around the broader information and also specific information to help you aim, save, and invest to accomplish your retirement goals. The first part will be around perspective for what's happening in the economy and markets and other dynamics currently, and then again, a quick review of financial independence education items. As always, we want to focus and have you focus on the space between things that matter and things you can control. You can't control markets. You can't control whether or not you choose the right stock bond mix for your that's appropriate for your life stage, and saving the right amount, defining your goals, saving consistently, and diversifying appropriately by using a well-built investment portfolio through your retirement plan, or investing on your own, or through something like WealthStep Direct. As always, there are news bits that make markets bump around. There were political events and elections in Europe that made some waves in news. President Biden dropped out of the presidential race, endorsing candidate Harris. The Japan market suffered its worst day since 1997, related to concerns about the US. Growth fears made some markets nervous as growth potentially cooling, and the talk of some increased level of chance of recession in the future, although slowing fairly slowly. And the Fed lowered rates as inflation began to, or continued to appear to be under control, because the Fed doesn't want to increase or lower rates too soon and have that lead to a boost, too much of a boost in growth that might spark another period of inflation. So that 0.5% rate cut was the first time in a while that there'd been a cut after 11 hikes during the COVID period, the post-COVID period, where inflation was picking up speed and the Fed was trying to control inflation by raising rates. That's a typical tool used by the Fed. Inflation has come down substantially from 9% in the middle of 22 to more recently down to about 2.5%. So that's good news from the standpoint of the Fed and reducing the inflation factor that can damage the economy. Both stock and bond markets were positive for the quarter. Surprisingly strong quarter for bonds, although not that surprising because when there is a rate cut, lower rates lead to an increase in bond prices because existing bonds with higher rates are perceived as having more value, so their prices go up, whereas newer bonds would be coming out at lower rates. Overall, unemployment went up a little bit, but not dramatically. And overall GDP or US economic growth measures show signs of a bit of strength, but forecasted numbers are a bit lower, down to about 2.5%. Overall, markets were positive across the board with some very strong returns, especially while strong in the US at 6%, international at 8 to 9, global real estate with rates getting cut. That's an interest rate sensitive area. Got a boost to 16%, and bonds, because of those cuts, performed quite nicely. Over the long run, some longer time periods, we're still seeing large cap growth have dominant returns. But remember that when one part of the market is in favor for an extended period of time, that's oftentimes followed by a weaker period. So we definitely advise investors to maintain a diversified approach and not allow their portfolio to get over focused on the parts of the market that have done well recently. Continued questions about when and what degree of recession there might be in the future. Economists do believe there will be a continued economic slowdown. Whether or not there will be a recession is still unclear, but with slowing growth, that is a possibility and wouldn't be too surprising given that recessions are cyclical and do appear and happen every few years. Overall, inflation, as mentioned, has come down, and that is helping the Fed. Some of that number is what's helped inflation come down is oil prices have come down, as gas prices as well as a result. And the Federal Reserve rates that were ratcheted up gradually after the global financial crisis years and then brought back down during COVID were ratcheted up as inflation picked up speed to try and control inflation. That's one of the Fed's tools for doing that. And now that inflation seems to be relatively under control, rates are starting to come down, and the projected numbers about rates are over the next several years to come down closer from mid upper 4% to around 3%. And as a reminder, we're coming out of a period where savings accounts and money market funds during a very low Federal Reserve interest rate period returned almost nothing, almost 0%, but that has changed with interest rates going up. So if you have spare cash that you're not going to be using for a while and that is not for your long-term needs, and you don't need it in the immediate term for immediate spending, it can make sense to put that into a money market account or something similar, or money market mutual fund, to earn some kind of rate of return closer to 4 to 5% currently. So rather than having that lose against inflation, that can help generate a little return and fight inflation while you're waiting to use it. Generally, again, if for money that is to be used 5 years from now or longer, we generally suggest a longer term investment strategy. And if it's less than 5 years, something shorter, so that your money is not bumped around by volatility when volatility happens, if it's money you plan to spend in the near future, so that your spending isn't impacted. That brings us to our quick review of the general retirement education principles. There is a more complete video on WealthStep's video page, so please take a look there, but we'll just give you a quick preview here, and then you can dig deeper in the other video. The key things to think about are what matters most. That's the focus of that main video and this video section around retirement plan basics. It's important to avoid emotional investing. The key thing is to know and use the stock bond mix that's appropriate for your life stage. And it's important to know what the different types of risks are, and they're not always what you think. And one of the worst types of risks is inflation and emotional investing, not market volatility in the long run. We cover that in more detail in the full video. So a couple key points. AIM is about knowing your goal, how much you're going to need to be able to stop working or working less. Save and invest has to do with how much you need to save and how to invest in order to accomplish that AIM number. So a general rule of thumb is 10 to 15% per year of your income. However, it may be less than that, or it may be more than that, depending on your goals, your age, how much you've saved already, and how much you plan to spend in retirement, when you plan to retire, if you plan to retire early, and so forth. So 10 to 15% is not a perfect number, but if you're not sure what to do, we suggest starting at 10 to 15% if you can in the upper range of that, and then adjusting afterwards. But don't wait too long to figure out what an appropriate number is, so that it isn't too hard for you to catch up later if you're still under saving. The older you are and the less you've saved in the past, and the younger you plan to retire, and the longer you might live, the more important and more likely it is you're going to need to save more than 15% per year. And then investments, again, by life stage, that's fairly simple. Talk about that in a moment. But we do want to remind, after many meetings with thousands and thousands of people over the years, there's a pattern that the younger people are, the less important they think it is to save, and that they'll deal with it later. And the people in the later stages of life really wish they had started sooner. So if you're not sure and you're a younger person in your 20s, for example, go ask someone, a colleague or a friend or family member who might be in their 60s or 70s, and ask them if they wish they had saved a little more earlier. We think we know what answer you will get. And as a reminder, stock markets tend to produce the longest or biggest returns in the long run, but as you can see here, can be bumpy. Stock tend to be bumpier in the short run, but have higher growth rates. Bonds, less bumpy, but lower returns. Treasury bills, or sort of enhanced cash, you might call it, even smoother, but much lower returns. And inflation is just below treasury bills. So if you invest in treasury bills or money market funds or something similar, you may keep pace with inflation roughly, but you won't be beating inflation. So most people need to invest in the long-term portfolio of stocks and bonds to accomplish their goals. Otherwise, you're just going to have to save a whole lot more. And most people struggle enough to save already, let alone saving extra for extra conservative, to make up for or offset extra conservative investing. And remember, if you're not investing at all and you're just having a savings account that is earning 0%, it's sort of like having a line right here. So you're losing a lot just against inflation over time, let alone against your goals, or versus trying to accomplish your goals. WealthStep 401k plans tend to use one of two different types of portfolios: target allocation funds, 4 different portfolios for different stages of life that are designed for the different ages shown here, where you start at 100% equity, then 75%, 50%, and 25% with the remainder in bonds. The idea is to gradually step down and reduce stock market risk as you get closer to and into retirement. Target date funds, similarly, follow a more automated pattern where you don't have to make those changes yourself, and it gradually changes the stock bond mix over time. And that allows you to just pick a fund that corresponds with the year you plan to retire, and really the rest of the work is done for you. So that makes it very easy. As a reminder, when people make decisions based on emotions, that tends to lead to lower returns, because people tend to panic when the market is down and miss the recovery. Whereas if you stay in it, even if the market cools and you capture the full recovery, you tend to get something more like the full market return over time. This is an example of just only the stock market with no bonds. But the idea here, if that were the case, would be about an 8% return for doing nothing and just being in the market and sticking with it, versus about half that by moving in and out and trying to guess out of strategically or tactically rather, or just out of fear. So once you access WealthStep, there are multiple tools here. You can use the planning saving advice tool to review, input your own personal information and get a sense of how much you might need in the future and how much to save now, a life stage based investment advice recommendation module, and then the full education video mentioned previously under the video section here. And for those that are curious, WealthStep has multiple service types for 401k plans, for individual investors, and for digital only to access just WealthStep advice tools online, advice modules, and then there is a general public access. There are fees for the first 3 levels. When it's a 401k plan, that's paid for by the company almost always. The general public version is free, but it's much more limited in terms of the advice. The idea there is to help people who can't afford advice to still have something to help them get on track and improve their financial futures. So remember to aim, save, invest, and spend wisely, and be smart about the risks you take so that the risks work in your favor and not just against you. And with that, we encourage you to watch the full video and be a smart and disciplined investor.